So, how healthy is your business? Really? It's such a simple question, right? But the answer can feel super complicated. Well, in the next few minutes, we're going to cut through all that financial jargon and give you the tools you need to read your company's vital signs like an absolute pro.
Look, bringing in revenue is great, but it's not the whole story, not by a long shot. A truly healthy business is stable. It's built to last. So how do you actually measure that stability? How do you know for sure if you're on the right track? Well, that's exactly what we're here to figure out.
Okay, so to get our answer, we need a specific tool. And the most fundamental one out there is the balance sheet. Honestly, the best way to think about it is like a high-resolution photograph of your company's entire financial situation at one single moment in time.
And that photograph, it tells a heck of a story. All on one page, you've got everything your business owns, everything it owes, and what's actually left over for the owners. And when you put this together with your income and cash flow statements, boom! You're no longer guessing. You're making sharp, informed decisions.
Now, at the very heart of the balance sheet is a really simple but incredibly powerful formula. You could call it the golden rule of accounting. It's the one principle that keeps absolutely everything in perfect balance.
So let's break it down. First up, assets. This is basically all the valuable stuff your company owns. We're talking about the cash in the bank, the inventory sitting in your warehouse, the computers on everyone's desks, the machinery. You get the idea.
Then, on the other side of that, you've got liabilities. These are your company's financial obligations. It's what you owe to other people. Think bank loans, credit card debt, and all those unpaid bills from your suppliers.
And finally, we have equity. Now this one's simple. Imagine you sold off every single one of your assets and used that cash to pay off every single liability. The money that's left over, that's the owner's equity. It's your actual stake in the company.
And here it is, the equation that holds it all together. Assets will always equal liabilities plus equity. Think of it like a balancing scale. On one side, you've got all the stuff you own. On the other side are all the claims against that stuff, what you owe to others, plus what you, the owner, can claim. It has to balance, no exceptions.
Now, let's zoom in on that first piece of the puzzle, assets. Because here's the thing, they aren't just listed randomly on the balance sheet. They're actually organized by a really crucial principle, and understanding it unlocks a much deeper level of your business's health.
And that principle is liquidity, which is just a fancy way of saying how quickly something can be turned into cash. So you've got current assets, things you expect to use or turn into cash within a year, like actual cash or inventory. And then you have your non-current assets, the long-term stuff, like buildings and heavy equipment. This distinction, it is the key to everything we're about to talk about next.
So why does that separation matter so much? Because it lets us calculate one of the most powerful numbers for checking on your company's short-term health, the current ratio. This number tells you straight up if you have enough cash and other liquid assets to pay your upcoming bills.
The formula is super simple. You take your current assets and just divide them by your current liabilities. The debts you have to pay off within the next year. It answers a really critical question. Do you have enough short-term stuff to cover your short-term bills?
Okay, now if that ratio drops below 1, that's a potential warning sign. It literally means that for every single dollar of debt you have coming due, you have less than $1 in easily accessible assets to pay for it. That suggests you could really struggle to meet your obligations. A ratio greater than 1, that's where you want to be. That's the healthy zone. It shows that your company has the financial resources right now to stay solvent and handle its short-term debts. You can definitely breathe a little easier.
And if your ratio is up at 1.5 or even higher, you're generally considered to have plenty of liquidity, a nice, strong financial cushion. But, and this is a really big but, a ratio that's too high might actually mean you're not using your assets very well. You could have way too much cash just sitting around doing nothing instead of being invested for growth.
And that brings us to some super important context. You've got to remember, the current ratio is just a snapshot. And what's considered a good number can be wildly different from one industry to the next. A retail store is going to look a lot different from a software company. The real power here is in tracking this number over time and comparing it to others in your field.
All right, so you've got your ratio, you've got your diagnosis. The next obvious question is, what can you do to actively improve it? Well, one of the most powerful levers you can pull is hiding in plain sight, right inside your liabilities. We need to stop thinking of accounts payable as just a list of bills and start seeing it as a strategic tool for financial health.
I mean, this quote from City National Bank just nails it. Managing when and how you pay your suppliers isn't just some boring administrative task. It's a core financial strategy that can directly boost your company's bottom line.
So here's the game plan. You want to maximize your days payable outstanding, or DPO. That's just the average number of days it takes for you to pay your suppliers. By strategically and responsibly extending that timeline, you get to hold on to your cash for longer. You're basically using your vendor's credit as a short-term, interest-free loan. That conserves your cash and boosts your liquidity.
Now, trying to manage all of this manually with spreadsheets and paperwork, that can be a total nightmare and a recipe for mistakes. This is where automation is an absolute game changer. It streamlines the whole process, cuts down on costly errors, and adds layers of security, which lets you execute your DPO strategy with some real precision.
And this is where it all comes together. Check it out. By strategically extending your DPO, you hold on to your cash. That directly increases your current assets. And since your current liabilities haven't changed, that top number in your ratio formula gets bigger and the whole ratio gets stronger. It's a simple, strategic move that creates this powerful ripple effect across your company's entire financial health.
So we end right back where we started. But now you've got the tools, you've got the equation, you've got the ratio, and you have a key strategy. So take a fresh look at your own business. What story is your balance sheet telling you? And maybe more importantly, what are you going to do about it?